All right, let's jump straight into this explainer and tackle a massive elephant in the trading room. Why on earth do so many retail traders get incredibly frustrated by constant stopouts and false breakouts when trading trend lines? Think about it. They're probably the most widely used tool in all of technical analysis. Yet, if we're being totally honest here, most of our charts just end up looking like a messy laser light show. If you've ever meticulously drawn what looked like an absolutely perfect diagonal line, only to have the market utterly ignore it, well, stick around because you're in exactly the right place.
I want you to be really honest with yourself for a second. How often do you buy a pristine trendline retest or maybe jump right into a breakout only to watch the market immediately reverse, completely sweep your stop loss, and then just casually take off in your original direction without you? It's literally infuriating, right? You followed all the textbook rules, but the market punished you anyway. Well, the sources we're digging into today reveal exactly why this happens. The big players, the smart money, you guys, they know exactly where you're drawing those lines. So how do we fix this? It requires a massive mindset shift. See, amateurs tend to treat trend lines as these magical, rigid barriers, almost like a brick wall that price absolutely has to bounce off of. And because of that, they take blind entries the exact millisecond price touches the line. But professionals, it's a whole different story. They view trend lines as dynamic liquidity zones. They rely on the actual market structure first, and they absolutely always wait for confirmed entries. This right here is the blueprint for everything we're about to unpack.
Okay, here is our playbook for today. We're going to start by unpacking the liquidity trap, then look at how to construct a valid trend line, break down the tactical execution for bounces and breakouts, and finally, wrap up with the risk and psychology you need to actually keep your profits. Let's kick things off with Section 1, Stop Drawing Random Lines, also known as the liquidity trap. So the crucial thing to understand is that trend lines frequently act as inducement areas. Picture a retail trader buying a trendline support on Bitcoin. Now, where do they put their stop loss? Right below the line, right? That creates a massive pool of sell orders. Smart money actually needs those orders to fill their own huge buy positions. So what do? They push the price briefly below the trend line to trigger those stops. That's a classic liquidity sweep. And once they've grabbed what they need, the market reverses sharply. You aren't just unlucky, you're literally providing the liquidity.
Which brings us to a really common misunderstanding. A trend line doesn't actually determine the trend. True market structure is what actually matters. Look, if you're in a downtrend making lower highs and lower lows, a break of a diagonal line means absolutely nothing if the previous structural lower high hasn't been broken. The market is still bearish. Don't let a broken line trick you into buying against the true momentum.
All right, moving on to Section 2, Building a Valid Trend Line. To avoid the trap of forcing a setup where the price action is unclear, just follow these simple steps. First up, identify at least 2 to 3 really clean swing points. Now, I know there's that age-old debate of, do I connect the wicks or the candle bodies? Honestly, the answer is simple. Just connect whatever gives you the most touches. Draw it where the market clearly reacts. And finally, treat the line as a zone. The market is messy. It's practically never going to respect a line to the exact pip. But what if you're kind of on the fence about whether your line is actually reliable? Well, watch out for these warning signs. If the line has an overly steep parabolic slope, a break is probably imminent. Those are almost never sustainable. Also, keep an eye out for price hugging or clustering at the line. A strong level should cause an aggressive bounce. If price is just awkwardly dragging along the trend line with shallow little bounces, demand is drying up fast. Let's dive into Section 3, the trendline bounce. Now, if you're trading something volatile like gold or Bitcoin, impatience will absolutely destroy your account. You've got to confirm the true trend direction first, then let the price pull back into your trendline zone, but, and this is key, sit on your hands. Don't enter yet. Wait for a solid confirmation signal, like a strong bullish engulfing pattern or a long wick penmoir. Finally, zoom out. Check the higher time frame to make sure your entry actually aligns with the macro momentum. Let's compare these two approaches. The blind touch is basically rolling the dice. The confirmation entry, that's how the pros do it. Let's say you're looking at a 5-minute Bitcoin chart. Let the price dip just a tiny bit below your trend line. Let the impatient breakout traders start shorting and the impatient bounce traders get stopped out. Once you see a strong, aggressive candle close right back above the trend line, boom, that's your entry. You're entering after the trap has already been sprung.
Okay, Section 4, the breakout and retest.
So what happens when a trend line genuinely breaks? To avoid false breakouts, you need to recognize the anatomy of a valid setup. The secret sauce here is momentum loss right before the break. If you're in a strong uptrend, you don't just want to see the line break. You want to see the market fail to make a new high first, like forming a double top. This kind of structural exhaustion, paired with the trendline break, is your double confirmation. Oh, and the golden rule? Literally never enter on that initial breakout candle.
So if you aren't entering on the breakout, when do you? You wait for the retest. This brings us to a massive edge, the break and golden retest. After an impulsive breakout, the market is naturally going to pull back. If you draw a Fibonacci retracement tool over that initial breakout move, you'll see price frequently pulls back squarely into the 50% to 61.8% zone, which often lines up perfectly with the backside of your broken trend line. That confluence is an incredibly high probability setup.
Which leads us perfectly into our final section, Part 5, Risk and Trading Psychology. As you can see here, there is a massive difference between amateur and professional risk management. Bad risk management places the stop loss exactly on the line, which is quite literally the perfect place to get hunted. Good risk management tucks it safely beyond the wick of your confirmation candle. As for targets, don't just close out of random fear. Target the next logical key level for at least a 2-to-1 reward to risk ratio. Doing this ensures that even if you only win half of your trades, you are still highly profitable in the long run. It really all boils down to this. The key to success is not constantly switching strategies, but mastering one setup and applying it with absolute discipline. Honestly, boring is profitable. Having the sheer patience to sit on your hands, wait for those 3 clean touches, wait for the liquidity sweep, and wait for that confirmation candle, that is your ultimate edge. Stop drawing 10 different lines on your chart. Just wait for clear structure, let the impatient traders get trapped, and then execute flawlessly. So as we wrap up this explainer today, I want you to really think about your own personal trading style. Looking at what we've just covered, are you more comfortable trading trendline bounces, just riding the existing momentum of the market? Or do you prefer hunting for that perfect structural reversal to catch a massive breakout? Understanding your own comfort zone is really step 1. Thanks so much for joining me today, and hey, remember, trade the structure, not just the lines.